Welcome to Thoughts on the Market. I'm Michael Zezas, Head of Public Policy Research and Municipal Strategy for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the intersection between U.S. public policy and financial markets. It's Thursday, April 29th at 10 a.m. in New York. Last night, President Biden addressed a joint session of Congress, laying out his multi-trillion-dollar plan to rebuild the country's existing infrastructure and build a new infrastructure to deal with the environmental and social challenges facing the country. He also laid out a multi-trillion-dollar tax increase to help finance the whole thing. Such dizzying numbers can be confusing when trying to figure out what it all means. Here's 3 takeaways to help ground you as an investor. First, taxes are going up, but probably not as much as advertised. If you're a regular listener, you're familiar with our rule of 2 Joes, where President Joe Biden lays out the ambition, and Senator Joe Manchin, who we use as an example of moderate Senate Democrats, lays out what's possible in terms of policy change. These moderates hold sway because they're electorally vulnerable, thus more likely to bargain for their interests, providing them substantial leverage in the Senate where Democrats' 50 seats gives them no margin for error on votes. Applied to these proposed tax hikes, that means that instead of the capital gains tax on incomes above $1 million going to 39.6%, we think it goes to 30%. Instead of the corporate tax rate going to 28%, we think it lands at 25%. And some campaign proposals, like a fresh payroll tax on incomes above $400,000, don't even make it into the final proposal. Second, smaller tax hikes mean deficits will keep going up. In the near term, this is a key support for economists' view that the sharp economic recovery in the U.S. will continue. The spending in this plan not only is greater than the tax increases, but should carry a higher multiplier effect. In short, while some people and companies will feel the sting of higher taxes, in the near term, the economy as a whole should grow. And that brings us to point number 3. There's investment opportunities to be had here if you just follow the money. Now, the net impact of all this money flowing into the economy could mean higher inflation expectations in the near term, leading to steeper yield curves and squeezing corporate margins. So our equity strategy team thinks the best returns of the S&P 500 this year could be behind us. But at the sector level, there's plenty of outperformance potential in places where this government spending will directly flow. Some of our analysts' favorites on this theme include steel and cement, clean energy, and healthcare. Thanks for listening. If you enjoy the show, please share thoughts on the market with a friend or colleague, or leave us a review on Apple Podcasts. It helps more people find the show.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.